Hello, I'm Kent Kramer, Chief Investment Officer of Foster Group, and this is our normal financial perspectives for the week ended Friday, October 9th. You may have heard the phrase October surprise, which kind of refers to deliberately planned or maybe unplanned events that happen around elections that fundamentally change the direction of the election. If you think back to 2016, it seems like James Comey managed to insert a few October surprises between the election and Secretary Clinton and now President Trump. For investors this year, I guess we didn't have to wait till October to find surprises. It's been a year of surprises with public health issues, the way the economies work. Now we're back in an election season. And as we're going to see in here in a little bit, October surprisingly maybe looks a little different than some other parts of the performance of stock markets this year so far. Before we do that, though, let's take a quick look at how things are going in the economy. You know that normally I will put up some kind of figures about employment and unemployment. One of the reasons that I like to do that is because unemployment is one of those few measures that the government looks at almost every week that provides a pulse on economic activity in sectors of the economy as well as regions of the economy. If we look at this chart from the Bureau of Labor Statistics, what you can see is there are certain sectors of the economy that are coming back more quickly than others. And some are kind of stubbornly seeing large unemployment numbers persist. Look down there at leisure and hospitality with a 19% unemployment rate still at the end of September versus the national unemployment rate of 7.7. By contrast, if you look at education and health services at 5.1%, the unemployment rate in those sectors of the economy is lower than the overall national average. And you can see kind of that spread of different sectors of the economy and how unemployment is starting to lower in some areas and still stay stubbornly high in others. We can also see this regionally. The chart on the right shows how unemployment is doing in each state. The darker state colors are ones where they're having persistently higher unemployment. So California, Nevada, Arizona, Illinois, New York, those are all states that are experiencing relatively high unemployment rates, while you can see some of the lighter colors where unemployment maybe didn't get initially as high during the initial stages of the COVID-19 crisis, or has just come back more quickly than some of those other areas that we see in the darker colors. We talked about returns for the stock market in the month of October. The last 2 weeks has seen kind of a change in the way markets have been moving. As we'll see in a minute, U.S. large growth companies have been the star performer so far in 2020. But for the first couple of weeks of October anyway, other parts of the market began to do better, maybe surprisingly so. Value stocks as opposed to growth stocks seem to lead the way a little bit these first 2 weeks of October, while growth stocks have really been the performers. These charts just show the differences between different ways to measure factors in the market, the size of a company, the valuation of a company, whether the stock price has momentum, all different kinds of ways to measure what kind of company stock it is and how those stocks are doing relative to each other. This chart looks at the Russell 1000 Growth Index and the Russell 1000 Value Index. These two indices, they measure large companies in the United States, and they sort them by whether they're a value company, meaning you're paying less for the book value of the company, or a growth company, where you're paying more for the book value of the company. So think of it as less expensive and more expensive. You can see that over the last 20 years, the value index, the kind of the green line there, has really led the way. There's been an advantage for value stock investors over growth investors. Historically, that's been true, and academics have found that value stocks over time, over longer periods of time, tend to outperform growth stocks. Though at times, growth stocks do extremely well, and they will outperform value stocks. This year, 2020, that's really been the case. You can see this 20-year picture that value had a steady lead, but that lead was quickly kind of reversed and eroded going into 2020. That's the box on the right there showing value steeply declining at the beginning of the COVID-19 crisis. Growth declined as well, but then came back very strongly. Here's a picture of the year-to-date numbers for growth and value stocks so far. And what you can see is in 2020, the growth stocks have outperformed value stocks by 35.9%. That's an incredible difference. That's a 3-year compounding difference equal to 10.45% per year. So why is that value stocks tend to outperform growth stocks? Or at least why is it that financial economists and academics think that value stocks tend to outperform? Well, historically, the numbers have said that they do. If you're a very long-term investor and you're investing in value stocks over growth stocks, by most measures, those value stocks outperformed. The premise behind the idea of a value stock being better than a growth stock is you're paying less for the future earnings of a company when you buy a value stock. You're buying something on sale. If you're buying a growth stock, you're buying it at a premium to the value stock. All other things being equal, if price matters, there's more room, it seems, for a value stock to increase or to appreciate in value versus a growth stock where the price has already been bid up relative to the book value or the market value. Here you can see a chart, and I'm going to focus just on U.S. large growth companies and U.S. large cap value, the first line and the third line. And for the 10 years ended September 30th of 2020, if you look at those that first 10-year period, or I'm sorry, this last 10-year period, U.S. large growth outperformed U.S. large cap value 17.3% to 9.9. If you look at the 10 years previous to that, so the 10 years ended September 30th of 2010, you see exactly the opposite story. U.S. large growth companies actually returned a negative 3.44% on average per year, while U.S. large cap value companies returned a positive almost 2.6% per year to investors. The 20-year numbers are remarkably close, 6.4 and 6.2. And we saw that in the earlier chart as growth really closed the gap with value through 2020. Now the question for investors is, well, what should I be investing in now based on these current valuations and all the price momentum we've seen in growth stocks? One way to look at that is just to talk about, well, what's relatively expensive and what's relatively cheap. If we look at the measure again, so we're looking here at price to book, you can see the price to book of U.S. large growth companies is 11.8. That's the ratio. For U.S. large value companies, it's 2.2. So the difference between the price to book for growth companies and large value companies basically tells you you're paying a premium of 536% for the book value of a growth company versus the book value of a value company. You can also measure that same thing based on the price to earnings ratio. If the price earnings ratio of a U.S. large growth company currently is on average 33.3, U.S. large cap value 22.1, you're paying a 151% premium to buy the earnings of a growth company versus the earnings of a value company. Historically, you can see kind of how these valuations have varied, and they expand and contract over time. U.S. large growth has an average price to book ratio of 4.35. It's currently at 8.2, so it's almost twice its historical average. And you can see at the end of August, right before September's decline in growth stocks, that number went over 10. If we look at U.S. large value and U.S. small value, what you see there is those valuations based on their price to book are really kind of in line with their historical averages. So the question is, due to the expansion of that multiple as growth stocks have become more expensive, was the turn down in September, is that something that kind of investors have been wondering, well, when is this going to happen? When are growth stocks going to revert to their mean, and when would value stocks maybe start to see an increase in their stock prices? Just how unusual are things right now? Well, I've given you a couple measures. This is another one in terms of a statistical outlier. This graph shows 3-year rolling returns of value stocks over growth stocks, so the difference between returns. So if you go out to the right hand of this chart, you see returns, 3-year rolling averages, where value stocks were outperforming growth stocks. You can see some pretty big numbers there where value had big advantages. If you look at the left side of the chart, you see those periods of time when growth stocks were outperforming value. So you had a negative value premium, meaning the value stocks were returning less than the growth stocks. Well, the period that just finished in June of 2020 was the worst spread in terms of value to growth ever, since we started measuring things back in the 1920s. That is what you mean by a statistical outlier. It is the worst observation in terms of growth outperformance over value, depending on which side of that equation you're on. If you're a value investor, it's the worst observation we've ever seen. So the question is, can that persist? It doesn't seem likely that it would persist, at least at the level that we've seen recently. And over time, as you look at these observations, this is where people have said, well, value tends to outperform growth over long periods of time. You look at the number of observations where value has outperformed growth, you'd think over time, maybe that's where you want to be in your portfolio. Academics have said value tends to outperform. If we look historically, it makes economic sense to think I'd rather own a stock where I'm paying less for a dollar of earnings and where I'm paying more for a dollar of earnings, all things being equal. When will this reverse? When will we see the change happen between value and growth? It's really hard to say. The idea here, though, is the economic sense behind paying increasingly high prices for growth stocks doesn't seem to make sense for the long term. However, for investors, sometimes it takes a little bit of patience to get to those things that seem to make sense. And my quote today is from John Jack Bogle, the founder of Vanguard. And what he talks about here is for investors, sometimes it just takes a lot of extra character or guts, he would even say, to stick with your investment philosophy, to stick with the things that seem to make sense, that I'd rather buy value companies than growth companies, all things being equal. But sometimes you have to go through periods of time when, boy, you feel great about your decision. But other times, maybe like this one, if you're a value investor, you really feel bad about that decision. But it's hard to stay with it, even though it makes sense. We think value investors will at some point be rewarded for investing in value companies. We're not always sure when, but we do think it makes economic sense. That's our update for this week. If you have any questions for the team, other things you'd like to see us address, here are some contact information you can use to reach us at Foster Group. Again, thanks for taking the time to watch. If this has been helpful, we hope you'll share it with some of your friends. We'll see you again next time.